Brent crude climbed back above $103 on Monday after Trump rejected Iran's ceasefire response as totally unacceptable. But the more revealing number isn't the price, it's the timeline beneath it. Saudi Aramco's CEO told analysts this week that oil markets may not normalize until 2027, even if the Strait of Hormuz reopens tomorrow. That forecast matters because it reframes the disruption from a temporary spike into a structural supply hole. OPEC output fell by 830,000 barrels per day in April to its lowest level since 2000, with Kuwait recording zero crude exports after its entire shipping route was blocked. Saudi Arabia cut production by 2 million barrels per day when Iran effectively closed the strait in late February, and those barrels cannot simply return to market once the choke point reopens. Aramco estimates the world has already lost roughly 1 billion barrels of supply during the crisis. The pipeline workaround, Aramco's East-West pipeline, now running at its 7 million barrel per day maximum capacity, is already stretched, and expanding export terminals at Yanbu takes months, not days. WTI swung nearly $19 in a single week last week, touching $107 before collapsing toward $88 on peace optimism, then rebounding when Trump's rejection landed. That range isn't volatility, it is price discovery in a market that cannot establish a floor, because the duration of the disruption remains the single unknown variable. Iran's response to the U.S. proposal explicitly treats the strait as a negotiating chip rather than an immediate concession, which means the supply disruption continues through any negotiating period. The strait remains closed. The question is whether the market has already priced in a multi-month closure, or is still treating each diplomatic headline as a resolution signal.
What the oil shock leaves unresolved is where Canadian monetary policy lands, and that is where the supply disruption stops being a commodity story and becomes a domestic one. The Bank of Canada has held rates at 2.25%, and TD Securities says it will hold steady despite the oil shock. But the broader market is already pricing differently. Canadian sovereign yields climbed across the curve on Monday, and a separate analysis flagged the possibility of up to 6 rate hikes if Iran-driven inflation becomes entrenched. Those two signals are not compatible, and the distance between them is where Canadian capital is being repositioned. The mechanism runs through jet fuel and food. Air Canada has cut more flights as jet fuel costs surge. Jet fuel is refined crude, so the Hormuz disruption transmits directly to airline operating costs and, through ticket prices, to consumer inflation. Farmers are simultaneously confronting rising fertilizer and fuel costs at spring seeding, a seasonal amplifier that feeds into food prices by autumn. Canada shed 18,000 jobs in April, its third monthly decline this year, bringing total losses to 112,000 since January. And the Bank of Canada's own survey now cites geopolitical risk, not trade tensions, as the primary threat to the economy. A central bank facing rising input costs, falling employment, and contested rate expectations cannot easily cut its way through this, and cannot easily hike without accelerating the labor market deterioration. Barrick Mining's $3 billion share buyback announced Monday alongside a profit beat on higher gold prices offered counterpoint. Gold is acting as the institutional hedge against exactly this dilemma, with spot gold posting a 2-week high on the same day oil surge. The TSX closed near a 3-week high on Monday, carried by commodity stocks, but that headline masks a rotation rather than a broad advance, with energy and gold pulling while rate-sensitive sectors remain under pressure from the yield curve move.
The convergence of oil supply shock, a contested Bank of Canada rate path, and Canadian job losses creates a specific divergence that Barrick's buyback makes concrete. Barrick launched the $3 billion repurchase ahead of a planned spin-out of its North American operations, targeting a New York primary listing later this year. The company is explicitly betting that a pure-play North American gold vehicle will re-rate higher than a diversified miner with African exposure, and the timing is not coincidental. Gold's 2-week high on Monday reflects the same institutional logic. When oil-driven inflation collides with a central bank that cannot respond cleanly, gold absorbs the residual uncertainty. Silver moved to a 2-week high on the same session, and the two metals are not moving together by accident. They are pricing the same unresolved question about whether the Hormuz blockade is temporary or structural. The verification threshold is the strait itself. Aramco's CEO has said normalization takes until 2027 even after reopening. If that assessment proves correct, the rate hike scenario moves from tail risk to base case, gold's bid holds, and Canadian rate-sensitive sectors face sustained pressure. If Trump's rejection of Iran's proposal opens a revised negotiation within the next 2 weeks, the IMO has cited 20,000 stranded seafarers on roughly 2,000 vessels as a humanitarian forcing function. A faster-than-expected Hormuz reopening would collapse the oil war premium sharply,
relieve inflation expectations, and expose the gold rally as premature. The leaning tilts toward a prolonged disruption, given Iran's explicit framing of the strait as a negotiating variable rather than a concession. But the condition that would prove it wrong is a concrete Hormuz ending agreement with a verified date, not a ceasefire and not a diplomatic communique. Watch for that distinction in whatever comes next from Islamabad. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.